This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. My guest today is Kevin Amolsch. Kevin is a private lender and real estate investor. Kevin, welcome to the show.
Gabe, I'm so excited to be here. You told me a little bit about your audience and your show, and it sounds like we're going to have a lot of fun.
I'm looking forward to it. So Kevin, I see the sign right behind you, Pine Financial. Tell us a little bit more. What is Pine Financial? Where are you based and what do you do?
Yeah, so we're out of Denver, just outside of Denver. Pine Financial Group is a hard money lender. Just real simply, it's a hard money lender. Now, I know the industry doesn't like that term so much, so I might get a few people out there that don't like that. The term now is private money, Gabe. So I guess we're a private money lender, which basically just means we accept investor capital and we loan that out to real estate investors. So non-bank financing for real estate investors and developers. Think about your fix and flips, your fix up and refinance to hold as rental properties, some repositioning of real estate assets. We're involved in all of that.
Got it. So let's say hypothetical situation, I'm a real estate investor and I come across a property, it needs some rehab and I'm thinking, man, this is really good. And I can buy this property for X amount of dollars, but I'm going to need about like 40 grand to fix it up. I don't have that 40 grand cash on me. I give you a call, right? And what would you say to me? What would be your conditions? What kind of interest rates are you looking at? And how do you determine whether or not you're going to help me finance my rehab?
Yeah, it's such a good question. And that does create some confusion how you ask that. So the way a hard money or a private money lender to real estate investors typically works is a senior lien position. So what that means is we want to finance the entire project, the purchase and the construction. And for us, which is a little unique, we'll finance your closing costs as well. The reason we're able to do that is because we don't have a loan to cost ratio. So we don't care about what it costs you to buy it and fix it. We're hyper focused on what the value will be when the project is complete. So we're going to cap our loan at 70% of the completed value, the ARV, after repaired value. And if you could find a deal strong enough where you could buy it and roll in that $40,000 in construction as you described, then we'll finance the entire thing.
Amazing. So typically, I know that that's not the only type of loans you guys do. You guys also do bridge loans and other stuff. But tell me, what are the most common types of clients you have?
Yeah, we're 80% residential, 20% commercial. So the most typical client of ours on the borrower side is your mom and pop real estate investor. So I'm sure you've seen the TV shows, the A&E TV shows, Flip This House or whatever they're called now. That is exactly our client. Someone who buys a house, fixes it up, and resells it for a profit.
Typically, how long does it take from the time that someone calls you and says, Kevin, listen, here's a house, here's a project. How long does it take for them to go through due diligence, get all the paperwork in order, and be able to close on it with your help?
Yeah, Gabe, that's going to depend on two things, two different loan products that we really offer. So you use the term bridge, which they're all sort of a bridge. That's just getting from point A to point B. So a means to an end, right? So there's two types of loans that we have. We have a rehab which I talked about, we fund the construction, or we just have a 90% acquisition loan. And that's where we're just going to finance 90% of your purchase. You're going to cover the 10% down and the construction. So both of them are fantastic. It just depends on the goals of the client, right? But if you're looking at a 90% loan, that is such a ridiculously safe loan for us because you're putting money into the construction and it's increasing the value of the asset, bringing our loan to value down and down and down, right? So in those, we don't get an appraisal and we could literally close in just a couple of days. Now, if you're doing a full rehab loan, which we talked about, finance up to 70% of the ARV, we do want a full appraisal done on those. So that's going to slow us down a tad. So we're looking at about 2 weeks to close if we're doing a full true fix and flip loan.
That's actually pretty good. That's faster than I would have expected.
Yeah, it's a little bit faster than the banks, right?
Typically, absolutely, yeah. So getting back to how you source the cash. So it sounds like you have investors who invest with you, right? And they get a certain return. And then you lend out the cash at, I'm assuming, a higher interest rate.
Exactly.
So what kind of rates can I expect to get from you if I were to borrow money from you?
Yeah, so I'm going to answer this question with a little story for you. So when I was first getting started in this industry, this was way back in 2006, and I was working with a lady named Susan. She was my mentor. I think having a mentor for your financial success is hugely beneficial. In fact, I think it's necessary if you're really going to reach your peak potential. So I got a mentor, and she took me under her wing, and she started teaching me this business. And she introduced me to John. Now, John was my very first private money investor, and he had a $100,000. So I knew he had $100,000. I knew he wanted to place it into a loan secured by real estate. So my job was to go out and find an investment for that $100,000. And so I went to the real estate sales meetings where realtors get up in front of the room and pitch their listings, right? And in those meetings, they typically will allow sponsorships. So I paid to sponsor those, and then they give me the opportunity to get in front of the room and pitch my service. So I just said, hey, I got a guy, and he's got $100,000. Does anybody have a fix and flip that they're looking to fund that's for about $100,000? And when Gabe, there was somebody in there flipping a condo, and he needed $100,000 to get this done. So basically, I just brought those two together, John and my borrower client, and I charged 4 points in origination. Now, a point is a percent of the loan amount and a lender fee. Okay, so 4 points on 100,000, $4,000 in fees. I gave 2 points to John, and I kept 2 points, and then he got to keep all the interest. All right, so that was my very first transaction, and he got 2 points and the return. So this is a long way to answer your question. Now, I've evolved quite a bit since then. In 2008, I started Pine Financial. In 2009, I created my first mortgage fund. Now, the reason I created a fund is because the feedback was this: we want more diversification. If I invest all of my money into one deal and they stop making payments, then my income stops. So I want a lower barrier of entry. What's a lower investment amount? How do I get in for less? And then, is there any way to create some liquidity, because private notes are not liquid? Yes, you could go out and sell a private note. There is a market for that, Gabe, but it's not a big market. In fact, it's very small, and a small market means that you're going to have to take a discount typically to sell that asset. So you're going to be losing money to liquidate. So how do I accomplish those 3 goals? We created our first mortgage fund. So that was in 2009. Now we just got approval on our 6th fund. And so that, to answer your question, these are paying preferred return of 8, and then there's a little upside depending on how well the fund does. So not the points and all of the stuff that I gave John. I've evolved over the last 15, 16, 17 years now. Wow, can you believe that? So now it's just a very passive pooled investment with an 8% pref that pays out every month plus some upside.
That's amazing. So your investors can get 8% and you pay them out every month.
We pay out every month. Yeah, from day one too. So if you invested today when we're recording this, what is this day? We're recording on May 10th. This is the recording. You would get from the 10th until the end of the month on June 1st. So the exact second the deposit goes in, it starts accruing interest, which is very different than a lot of pooled type of investments or funds.
Amazing. And then, so basically your job at that point on the other end is to put all that capital to work, right? So you're out there probably working with like real estate professionals, real estate investors, et cetera, to try to get that money to work for you.
Yep. And what's interesting is we never have any trouble loaning the money out. We have so many leads coming in. We're turning down great opportunities because we don't have the cash to fund it. Part of that is just because people love real estate investing, and there's a lot of profit and a lot of money in it. And 2, look, we're in a tough economy. There's a lot of uncertainty. And you have last March, right, Silicon Valley go down in your neck of the woods. So then you have these banks see one of their peers go down because of their investments and their strategy, and they get nervous. So now everyone's tightening guidelines. Banks are tightening guidelines. So if I've got a fix and flip and I can't get money from the bank because now they're requiring a larger down payment that I don't have, where am I going to go?
Yeah, exactly. Tell me about the states that you operate in, because it sounds like there's definitely some states that you prefer to do business in.
Yeah, I think the risk in this business is really being able to go out and touch the assets. So we want to manage these pretty well. We go out and do inspections and we release the money in draws. It's not like we just give them all the construction money, right? Show us you did the work and then we'll pay you just like you should do with your contractors. So we're out there looking at these. So it makes it a little tougher to expand geographically. So we're hyper focused on Colorado and Minnesota. We also do some business in Wisconsin, as you do, and in Washington, D.C. So those are our four markets. Now we accept investors from all over the country. It's just when we lend it out, we're very careful with that.
Yes. And when you mentioned that you are on your sixth fund, does that mean that after the fund reaches a certain dollar value, you close that fund and then you were going to start a seventh?
It's so funny. Every fund is because of a different reason. So my first fund that was in 2009, I didn't know what I was doing, right? I was taking the advice from the attorneys, of course, but they're very good at securities law, not operating a company necessarily. So my miss was I didn't charge any management fees. And so it takes a lot to manage a fund like this. And I was only making money from fees I was charging the borrowers for originating the loans. So all of the management was free on the fund. So I stopped that and I started my second fund and I started charging a management fee. Now that fund I had to stop accepting investors in because I hit a non-accredited investor limit. So if you know anything about securities laws, if you have a private offering, if you're willing to accept non-accredited investors, you cannot advertise. It's private. That's one. But two, you're limited to 35 non-accredited. So then I had to start another fund. So that was Fund 3. The funny thing about Fund 3 is I was going public at that time. We were doing a public offering, and that took for freaking ever. So my attorney told me, I don't know if this is true, so fact check me. My attorney told me we were the first we were the first mortgage fund trying to go public with a Reg A after the Jobs Act. And the SEC did not want to approve it. So they were just making us jump through hoops. This target was seriously moving. Every time we got feedback from the SEC, it was a different requirement. And this just went on for over a year. So while I was waiting for that, I had to start Fund 4 because I had already hit my 35 non-accredited in Fund 2. So then we skipped Fund 3 while we were working on that, Fund 4, and then we've got Fund 3. That was limited to money in Minnesota and Colorado, which we were growing fast and expanding. So we had to start a new fund so we could have another Reg A that accepted all over the country. So that was Fund 5. So I see everyone has I know this is a really long answer for you, Gabe, but every different fund was a different reason for starting it.
Amazing. And so even today, do you accept both accredited and non-accredited investors?
Yeah, the great thing about a Regulation A is it's much higher scrutiny, right? So we have the full audited financials, very tricky to get an approval from the government, and they're strict on it. But in exchange for that, we can advertise and accept an unlimited number of non-accredited investors. So that's the huge advantage. And people tell me sometimes, why would you work with non-accredited investors? And the reason for that is because I want to help more people. Mm-hmm. Now, I understand that it's a little bit more hassle. We're accepting smaller dollar amounts, which creates more administrative headache. I get that, but we're creating a liquid investment anyway. So that's if they get panicky or they need the money back, we'll just give it back to them. So it's actually worked out really well for us.
Kevin, I know that historically, I think you started out being a real estate investor yourself.
Yeah.
Tell me about that little journey. And at what point did you say, you know what, I'm done with the fix and flips and the real estate investing, and I'm going to focus more on the lending? And how did that transition come about?
Yeah, and I still do my own investing, but I do bigger commercial buildings now. The little fix and flips, I don't enjoy that anymore. Now, I think you should do that because you could borrow from a hard money lender like me, but it's actually a good way for me to get going, right? But I was in college and I was trying to figure this business out. And I could tell you the story if you'd like, but I went into foreclosures first because that's where all the hype was, right? When you go to the seminars, everyone was touting foreclosures. And this was back in right after the dot-com bust. So 2001, 2002. And so that's what I was learning to do. And what I realized is that was very difficult. That was a very, very difficult business. But what I learned was owner financing strategies is far easier and more effective than chasing foreclosure. So it's a very different way to invest than all of the crowd was doing. right? So that created more opportunities for me. So I was going into the people's homes in their living room and trying to negotiate with them to sell me their house on terms. So I'd make payments to them instead of going out and getting funding. And I had a lot of success with that. I was buying 1 or 2 houses every single month. And then I got recruited to be an originator for loans, which I jumped on because multiple streams of income, right? We're taught this.
Yeah.
So I had my investment going and I was recruited to help originate loans, which was just fees as a fee business, transaction business. So I was doing both of those. And then I just really did fall in love with the financing side of real estate. Now, real estate investing is so vast. There's like more than I can even count ways you can make money in this business. I just kind of latched onto the financing side.
Very cool. When you mentioned that you were basically buying on terms, right? As you were working with the bank, you were working on actually getting financing from the owner and then paying the owner instead of the bank. Did you come up with that yourself, or did you go to one of those programs? Because I think there's a lot of programs and courses out there that promise to teach that, right?
All right, Gabe. So I'm gonna tell you, you're gonna hear my age come out a little bit here, but I went to a 2-hour seminar that I saw in the Denver Post. So the Denver Post was an actual print newspaper, and it was a classified ad. You don't see those anymore, of course. But I saw that little classified ad, come to a free seminar. And in that seminar, they talked about lease options, and then I got a free book. It was just a book that like $14 book or whatever. And I read that and it just clicked. It clicked. And then they had a second book, this author. It was two people authored the book. So they had a second book. So I bought that one. I went to the store and bought that one. So with those 2 books, I learned the strategy. And I for some reason, I felt confident just trying it. And so I just started picking up the phone and just cold calling people and seeing if they would talk to me. And I was able to put together a deal through that. And then I got invited into their mentorship. And that's funny. I say invited in. Of course, everyone is accepted if you give them the money. So I joined their mentorship program. It was $5,000, which was a ton of money for me at the time. And they mentored me for a year. And that's really what got me going.
Amazing. So out of curiosity, how long did it take? How many cold calls did it take to get that first deal done?
Oh, gosh, I don't know the answer to that, but it might have been close to 100. Because look, I didn't know what I was doing. Now, the script was in the book, right? So I was just trying to follow the script, but I was probably scared to death to pick up the phone and call someone I didn't know because I didn't know what I was doing. So I was just fumbling my way through it. And then you go out on a lot of appointments and go out and meet with sellers, and you hear a no after no after no. So it just takes some time to build up that confidence and get that first yes.
Where do you see the most activity in terms of markets? Like which part of the country are you seeing a lot of activity in? Where are a lot of your investors coming from?
Yeah. So if you're looking at like the fix and flip investor, that can be successful in any market. So you don't really have the fluctuation. You don't have market exposure because you're in and out of it so quickly. So it's hard for me to identify a market that I'm seeing a lot of success in. What I could tell you is the inventory is at historic lows, especially as a relation to the population. I mean, it's never been as low as it is right now. So there's definitely a housing crisis, if you want to call it that. And it's affordability crisis because when you have a lack of supply and a high demand, we have a high demand even with interest rates where they are. So if you have a high demand and a low supply, that's going to create pressure, price pressure. So it's difficult to find projects across the country right now. Think about it, Gabe. If you're looking for a fix and flip, you need a spread. You need to buy at one price and sell it at a wholesale retail, right? And that spread's how you make profit. But when you have a limited number of inventory, you have owner occupied buyers looking at wholesale type assets. So houses that need work to make them livable, owner occupants are looking at those because there's not a lot to choose from. Mm-hmm. So that drives up the price of those wholesale properties. But the retail side, you can't push that high. It's hard to push retail values because they're dependent on appraisals. So they need historic comparable sales to get a value. So they will go up, and we're seeing that, of course, but it's not going to spike like you would see the wholesale. There's a lot more movement on the wholesale side of the business. I know that's a kind of a detailed explanation there, but when you have a lot of inventory, a lot of houses to choose from, then the retail buyer, the owner-occupied buyer, is going to be choosing the nicer product, right? And so there's going to be a lower values for the wholesale, which creates the spread you need. So it's just tough right now.
When you're doing your due diligence on some of these loans, do you have to go out and make assumptions on, say, what the real estate market is going to be 6 months or 12 months from now, or what interest rates will be 6 months or 12 months from now? And what are your thoughts on that?
I think as an investor buying the property, you should absolutely look at that. We call it stress testing. Like if you're going to look at it, what if the rates go up? What is that going to do to the value of this property? Will I still be profitable if the rates go up a point or 2 points in the 9 months I'm going to own it, or the 6 months I'm going to own it? I absolutely think you should underwrite your deals that way. On the lender side, we're at 70% of the value. So even if interest rates pop a point and the value softens, we're still in a very strong position. So we're looking, when we underwrite, we're looking at what it is right now without any speculation at all. I just feel like we're in such a strong equity position that we can absorb any market movement in that short period of time. I mean, the market would have to move significantly to impact us at 70% of the value, right? In a 9-month period. So we're just not seeing that. So I guess it's different. It depends on what lens you're looking at.
Right.
Looking at it from.
Kevin, you're also an author. Tell us about your book, The 45-Day Investor.
Yeah, and I just had my second book come out that I don't think that was in my bio that you received, but the first one, The 45-Day Investor. So when I was buying a house or two a month, well, I was still in college, right? I was in college and I was working. I was broke. I didn't have money, and I was still buying a house or two a month. So I had like this little fame, if you want to call it that. I'd go to the real estate investment associations, the RIAs, which definitely you should do if you're interested in real estate investing. Join the RIA. So I was going to those, and people were just asking me like, how are you doing it? What's like, give me some advice, and I was getting this every month. And then they had the online forums, and I would answer people's questions and try to help them out. And people were just really attracted to that. And so I decided, I'm answering questions constantly, and I'm constantly trying to help investors out. Why don't I just help more people and write this book? And it started, Gabe, as a biography. Like this was just my story. And then it quickly turned into a how-to book with all the scripts and the documents and the forms and exactly the verbiage to use when you're negotiating with the seller. So it's all about lease options. And I picked the 45-day investor one because the domain was available, but it's the 45. You could buy a property in 45 days or less with no money down. So 45dayinvestor.com. And the second one here is the Fund Your Flip. They both actually went #1 on Amazon, so I'm super proud of that. But Fund Your Flip is all about hard money and private money and how to utilize that to fund fix and flips and do your fix and flips. So the proper way to analyze the projects, the different ways to use private money to increase profits, all of that's in Fund Your Flip, and that's fundyourflip.com.
I'm sure someone's listening and saying, how the heck did you buy 1 or 2 houses a month while you were in college with no money? And does that come back to your earlier comment about basically buying on terms, like seller financing?
Yeah, if you go into a living room and you're negotiating directly with the owner of the property, you don't need cash or credit. What you need is credibility. Like, do they believe that you're going to be able to follow through on what you're saying you're going to follow through with? If you can have that confidence, people will sell their house to you without checking credit, without asking for down payments, and they'll just accept payments from you. So whether it's taking over the existing loan and the existing payments, whether it's a lease, the lease with the option is the strategy that I had a lot of success with. So I'm going to just lease the property from you, and then we're going to lock in a price. So it's basically a purchase contract today at today's value, but I have up to 10 years, let's say, to exercise that option. So it's a long game, right? Because I'm not going to be able to flip that property and make my 30 or 40,000 like you see on TV. But I'll tell you, over a 10-year period, as that value goes up on that property, I'm capturing all of that appreciation, right? And then I'm able to create a little spread because I'm paying less per month than I'm charging my tenant. So it's actually a very, very easy, great strategy to get going.
Where else can people reach you? I understand you have a YouTube channel as well. Tell us about that. And are you active on any social media?
I love the YouTube channel. We're having so much fun with that. So we drop one video every single week, and then we do a podcast every week. So there's 2 videos going up every week. But the normal weekly video is short, like 5 minutes, and it's just some directly to the point piece of advice to help real estate investors make more money. So it's highly focused on investors and what they need and want right now. Sometimes it's about the economy. Sometimes it's evergreen, that this is a strategy that we know works and here's how you do it. So it's 1 a week. It's youtube.com/Pine Financial. So yeah, go there, check out the video if you like it, hit subscribe. That'd be great. And then active on social media. I'm so busy. I wish I was more active on social media. I look at Facebook to see pictures of my friends sometimes and my nieces and nephews and all of that and cousins, but I'm not really posting a whole lot. Callie in my office is helping with all of that. I don't have the tags, but we can get those for you. And this is kind of a fun story. So I have a blended family. We have 5 kids. Okay, I have 2. She has 3. My oldest and her middle have teamed up, and they came into the office and they said, we think you need TikTok exposure. So they put together this entire presentation. We set the leadership team down and my marketing manager down so that we were all in the room. And these 2 got up there and did their whole presentation on how TikTok will benefit us. So now we have a TikTok channel and those 2 are running it.
I love it. I love it. Hey, take help wherever you can find it, man.
That's
well done.
amazing.
Yeah. Kevin, thank you very much for taking the time to speak with us today. I'll put all those links into the show notes, and congrats on your success.
Gabe, thank you so much for having me. I really appreciate this. Maybe we'll have you on our show if you're open to it.
Definitely, man. Looking forward to it.
All right.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.